I know that you are a sort of a micro, more fundamental guy, and you think that we shouldn't really be too focused on Washington. But how can you not be now when every single client is asking you, what's going on?
You know, it's interesting. We just were in Europe 4 weeks ago this week, and it's the #1 question. If you have an hour meeting with an institutional client around the world, you're probably spending 45 minutes talking about policy and things that you actually don't have a lot of quantitative or analytical substance to, because it really is about conjecture at this point. When and if, when and if. And we firmly believe that the majority of our institutional clients, Vonnie, around the world are positioned for nothing to happen. There remains a lot of negativity with respect to the U.S. Now, in years past, investors around the world were negative on the U.S. because they were bitter they missed the rally, right? Now, we've seen a big move in European stocks. They've sold off a little bit the last 3 or 4 weeks. A big move in emerging market stocks. So the consensus is to be in those areas because of some perceived value or something like that. Now we've seen U.S. earnings come out pretty good. The market is rewarding the right areas. Investors on a near-term basis are taking profits in those areas that have been excessively strong in the last few months. So the essence of fundamental investing is working. But again, with respect to politics, does not drive the absolute performance of the stock market. The economy and the fundamentals of the companies within the stock market drive stock prices.
So how are they changing? We saw great results from Caterpillar, or great, relatively speaking. You know, McDonald's out today as well. We've, got some caveats there. The banks did okay in certain areas. How would you characterize the health of U.S. corporates right now?
I would say this. It's the yeah, but rally in the financials, right? Oh, the numbers are great. Yeah, but, we don't know what's going on with interest rates, right? And then with respect to McDonald's, let's say, 99-cent pop, as we call it in the Midwest and Canada. Yeah, but, how much further can the stock go up? What kind of institutional sponsorship do we have? And then you talk about industrials. Remember, a year ago, we were talking about an industrial-led earnings recession. And a lot of investors, Vonnie, were caught behind the 8 ball because they were not fully invested in industrials because they were so negative on overall global growth. Now we've seen a distribution and diversification with respect to growth in the industrial space, not just the internationally focused, but the domestic focused industrials look very good. So that's why I think the stocks continue to go up.
You've talked over the last few months, Brian, about the declining stock performance correlation. What's the impact on the investment process?
The impact on the investment process, as we like to call it in Canada, is one that we think investors need to focus more on intrinsic stock fundamentals and less about macro. We have seen such a reactive marketplace still. There's 3 phases to a bull market: the reactive phase, the acceptance phase, and the euphoric phase. We are still reacting to every little macro data point, and we're missing kind of the forest through the trees. The trees are all this macro stuff. We had consumer confidence today. That's great news. But the forest really is the fundamental attributes of these companies continue to do very well. And when you're a stock picker, you have to realize that companies begin to recover on a fundamental basis at different rates. So we would continue to implore investors to focus less on indexing, less on ETFs, and more on more concentrated 35 to 40 stock portfolios.
Brian, I just want to pick on a point you made at the start, saying you're in Europe 4 weeks ago, which leads to the euro question, which is obvious given the euro today, highest level since January 2015 against the dollar. What sort of hindrance is the strong euro going to have on European equities, particularly those exporters?
Well, I think it's a great question. I think that's why you've seen a little bit of a pullback on a relative basis of European stocks relative to U.S. stocks. I think investors weren't prepared for how strong the euro has been, number one. Number two, there's this broadly consensus opinion that Europe is excessively cheaper than the U.S. Well, you can basically say throughout time that price to sales, PE, price to cash flow are almost always less expensive than the U.S. The problem is with that euro strength, how is that denominator from here going to grow? How are earnings going to grow? How is cash flow going to grow in a stronger euro environment where these companies on a fundamental basis are just in the beginning stages of their recovery? So I think the market's got it right in terms of taking some profits from these European stocks.
Are you concerned about an ever softening US dollar though, Brian, or is that giving you, even more reason to celebrate?
Well, that's the forest of the trees comment, that we have so much investing habits and strategies focused on the macro. Now, we believe a year from now interest rates are going to be higher. We believe 3 years from now interest rates are going to be higher than they are today. If that's the case, we think too many near-term opinions with respect to interest rates going lower are are throwing near-term money into these interest rate proxies like utilities and telecom, and away from the banks and away from the real implicit growth companies within, we think, a value-led market, that investors are going to be kind of left holding the lurch again in terms of being too defensive with respect to interest rates being low.
But about the dollar.
Well, that's why, okay, so the dollar, remember, the dollar is reacting to this perceived notion that interest rates are going to remain lower for longer. Everybody's in that camp.
But they are in other parts of the world, which is also impacting the dollar.
Right, but at the end of the day, remember, the United States of America is the world's largest economy. We have the strongest companies in the world. We're the most diversified economy in the world. As the economy continues to recover, and oh, by the way, maybe we do see something out of Washington, maybe growth is understated, interest rates will have to go up, and the dollar will go up as well.
Okay.
Brian, just looking at a survey we've done, we've surveyed 30 finance professionals. We've asked them about the next bear market in stocks. The consensus seems to be late 2018. What do you think? Have you got a date when it's all going to come to an end, this bull market?
Oh, that's a trap. I love that. My response is blah, blah, blah. But I would also tell you this, is that stop reading textbooks. This recovery since 2009 has nothing to do with history, has nothing to do with textbooks. And what happens in a macro-dominated investment culture, we go back to the textbooks and say, we haven't had a recession for 8 years. Time for a recession. This is the slowest, lowest economic recovery in the history of recoveries. What happened in 2008, 2009 happens every 70 to 100 years, not every 7 to 8 years. Stop with the whole recession talk every 7 or 8 years. We're not going to have a recession until we see growth and CapEx being led growth, then we'll pull back. We don't recess from low levels of growth, we recess from higher levels of growth.
So very briefly, Brian, do you stick with the sectors that have been working then?
Yes, we do, but we're overweight industrials, healthcare, financials, and materials. Materials is a 3% sector in the U.S., much more important to Canada. We think financials over the next 3 to 5 years remains the biggest bet that you should be making right now, because we continue to believe that most investors are underexposed financials. Industrials is one of those great eclectic sectors where you can own from time to time here and there in different areas. Healthcare continues to be a contrarian type bet, and own those companies that provide the greatest products that quote unquote kind of keep you alive, so biotechs, devices, those types of names.